Back with first trades, and let's start decoding some of the earnings that we've seen. Shree Cement being one of them. The stock is doing really well in trade as we speak. You've had an inline set of numbers from Shree Cement. The revenue has seen a little bit of an uptick, but there's a little bit of the contraction on the margin, EBITDA, as well as the PAT front. But the volumes are looking really good for the cement maker in the quarter gone by. So let's try and understand a breakthrough of what the numbers were in quarter four, and more importantly, what lies for the company ahead in FY27. We have the MD, Mr. H.M. Bangur, joining us on the show. Mr. Bangur, morning, and thank you for your time. Let's first start by talking about your volumes. You've seen 6 consecutive quarters of muted low single-digit growth, and now the company has reported some very good volume performance. Your volumes are up 9%. From 36.5 million tons in FY26, you've guided for 40 million tons. Now, this implies roughly an upside of only about 10%. Can you help us understand if you're being a little conservative on the guidance, or do you think that this is a number that you would be comfortable to achieve?
Now, cement industry will be growing at around 7 to 8%. That is our assumption. And if that is the assumption, you are in the market with everybody having surplus capacity, then realistically more than 10% growth will be a big bonus. That's why we are saying only 10% growth this year. And it is a fair estimate what we are thinking. It is neither conservative nor aggressive.
Pricing, Mr. Bangur, continues to remain a concern. The industry, I remember, had attempted a price hike in April, but a major chunk of the price hike couldn't be absorbed and then had to be rolled back as well. Now with monsoons round the corner, are prices expected to remain stable till October, or could they decline further?
And is the worst question any management can say, because the prices depends on the market. Managements will always like to increase the prices, but the demand, supply, and everything put together, the problem is of the costing. The costs have increased tremendously because of the Gulf War. Now, if it ends, the prices may soften, or prices means the commodity prices may soften, and then we can remain with the same prices. If it is not softening, the war continues, which we don't know. The energy prices have gone up by 30 to 40%. And to maintain the margins without increasing the price is just not possible.
But that's the tricky part, right, Mr. Bangur? I mean, how do you balance realization discipline with volume recovery as you've seen in the quarter?
We will be continuously increasing our focus on premium cement, that is to increase our realization per ton. Also will increase, like to decrease cost by using alternate fuels. Industry is now very much going into the agro waste and RDF, that is municipality waste. These are the fuels which are eco-friendly and which is industry is using. We are also using and going to use in a big way. That is the future for our cost reduction.
Okay. And while we're talking about costs, Mr. Bangur, on the back of the West Asia crisis, a lot of your raw materials have seen an uptick, be it spot imported pet coke prices, be it packaging costs. You know, we've seen very sharp spikes in both of these commodities. Help us understand what your pricing action is going to be as a consequence of this, and what the impact on margins could be.
Impact on margin is a matter of price. Price rise when we can take, we will be taking. Right now, the margins are very bad in East, Central market, West India market. So with all these markets not having sufficient prices, margins are going to be affected one way or other. It is wrong to say that margins will not be affected. If the prices go up, your prices remain same, of course the margins will come down.
Is there a range in the worst case scenario? How much could the margin pressure be? some
No,
level
no,
that you have in your mind?
no. In fact, our thinking is yearly margins will increase by 4 to 5%. When we are talking on TV, everybody wants to understand the next 1 month scenario. But the long-term scenario is that this year the margins should increase by 4 to 5% compared to last year. Volume increase will be additional. So this volume increase of 10%, additional margin of 4%, now rest is mathematics.
Fair point, but what I also wanted to understand is how much of a price hike does the industry really need to sustain these kind of margin levels?
The industry will be needing, depending on the inflation, almost up to the inflation margin, because continuously cost saving cannot be there. Cost saving has been done by industry over last 20 years, and the industry is surviving because of cost saving. If you see that in last 10 years or 20 years, inflation was 7 to 8%, cost rise of industry cement is 3 to 4%. Sporadic 1 or 2 months in one area, the prices may go up because of the shortages at that point of time. But otherwise, the price rise is less than the inflation. That has to catch up. Now, inflation and price rise has to match.
Okay, so that's on pricing, but let's talk about your expansion plans. The company has now approved a new integrated plant in Meghalaya with a clinker capacity of 0.95 million tons, and you've earmarked a capex of 1,800 crores. If you could help us with the timeline as to when will this be commissioned and how much further capex will be required for this project and any other capex that you've earmarked for FY27.
Meghalaya project, normally we are not putting a 1 million ton kiln anymore, but it is a small state, the consumption is low. That's why we are putting it. And some margin is there that if necessary in future, with a small increase in cost, small further expenditure, the capacity can increase. But that is for the future. If the Meghalaya plant really takes off, as I expect, that in Northeast, the development will be much more, pace of cement consumption will be much better, and so we are bullish about the Northeast market of India. So that is for one. Secondly, overall, now for next 1 year or two, we will slow down our capex. We'll take only few projects, increase our capacity utilization, and then again go for it. So for 1 or 2 years, we have given a timeline of 2029 for 80 million ton. We will achieve it. Further capacity expansion, further plans, I am just not giving it.
Fair point. And I'm guessing that's what the cash and books as well is going to be utilized for. But Mr. Bangur, great to speak with you today. Thank you so much for your time.
Thank you.
Okay, from one